Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
I'm Scarlet, in for Matt Miller, and I think Eric Black-Tunis because he's not here.
Both of them are off. You're here, and thank God. Otherwise, I'd be all alone. But let's get now to the biggest stories in the more than $9 trillion global ETF industry. Of course, traders are on edge amid a crucial meeting between President Joe Biden and House Speaker Kevin McCarthy surrounding those debt ceiling negotiations. What's it mean for ETFs? We're going to try and figure that out.
And we'll look through that story through the lens of ETFs when we speak to Janel Jackson of Vanguard, who is going to look at fixed income.
And arguably, of course, the biggest buzzword of the year is artificial intelligence. We're going to take a look at how one machine-powered ETF picks stocks, and we're going to discuss whether it can actually replace the humans. And Scarlet, typically now we check in with Eric Black-Tunis. We're going to do that a little bit later in the show, so let's take a look at some of the flows, where the money was heading to in the ETF industry over the past week. You can see SPY up at the top with a big chunk of change. We're talking about $5 billion. Then we have small caps and long end treasuries seeing some love, as well as our investment grade bonds. So those are the inflows. Let's take a look at the outflows. You can see that actually this is interesting. Vanguard Value ETF losing some money, as are some short end bonds and the Qs. So some money coming out of those funds. And let's talk about the big two, because we talk about the big two all the time. It's BlackRock, it's Vanguard. I think this next chart really visualizes it nicely, just how big these behemoths are. You can see BlackRock in white there, then Vanguard in orange, State Street in blue there. So the big two, much bigger than the rest of the pack. And we're going to talk about Vanguard specifically right now.
All right, so let's pick that up and join Janel Jackson. She's the global head of ETF capital markets at Vanguard, one of the two big players here. Janel, so good to speak with you. It's notable that Vanguard, BlackRock, as well as PIMCO are all warning that the recent volatility we've seen in the Treasury space is the new normal. I'm curious to hear from where you stand. What specific opportunities does that create for Vanguard and its passive funds?
Yeah, hi, thanks for having me. It's great to be on the Ladies in ETF show today. So back at the beginning of the year, we were really talking about the return of fixed income in ETF land, and we continue to see that as a theme this year. So over 60% of flows into fixed income, into ETF instruments this year have been into fixed income products. So Vanguard is leading the way with cash flow this year with $37 billion in net inflows. And we've seen a little less coming into our fixed income products from an allocation perspective. So a little under 40% of those assets are coming into fixed income products. And to your point around what investors are doing, so what we've seen investors doing is taking some of the risk out of their fixed income exposures. They're realizing that they can get the same amount of yield without that interest rate risk exposure. So we've seen them coming out of, credit, corporates, et cetera, and moving that cash into treasuries and into even money markets. Talk about mutual funds for a second on an ETF show. But what we've seen from a product perspective, we've seen a lot of inflows into our short treasury ETF, VGSH, and also into aggregate bond products. So our product is BND. On the flip side, where we've seen that money coming from is our short-term credit product, which is VCSH.
Right.
So like I said, it's a great opportunity to shout out our friends on the mutual fund side of the business. We've seen so much money going into money markets with yields over 5%. And the one thing I would yield investors should be thoughtful of, what are they paying for those instruments? It's great to be grabbing this yield while it's available, but be thoughtful about the expense ratios for those instruments as well, because that's coming right out of your pocket.
Well, let's talk about that a little bit. And again, this is an ETF show, to your point. We've been talking about mutual funds more and more specific to that money market story. When you talk about the expense ratio on some of these mutual funds, we were talking with Eric Black-Tunis actually before the show, and he points out that if you look at a lot of the Vanguard money market mutual funds, they cost around 9 basis points. In some cases, you have competitor products more than double the cost, but they've seen more inflows than those Vanguard money market funds. How do you explain that?
Yeah, I think it's just investors really have to look behind the curtain, just like they would with any other mutual fund or ETF product. I think maybe we take for granted that, money markets are going to be cheap just because of the types of investments. But investors still need to beware and be cautious and be thoughtful about what they're paying and not think about cash just being swept into another vehicle. What vehicle is your cash being swept into, and how much is that vehicle costing you? So just because it's a cash-like instrument, you still have to be thoughtful because it's a mutual fund, just like an ETF or any other product. You really have to pay attention to what you're paying and what you're getting in return.
I wonder if you see a lot of the money market mutual funds plowing some of those allocations back into the fixed income space through ETFs.
Yeah, I would say that that's probably a bit of what we're seeing on the short-term treasury space. Another place where we're seeing a lot of inflows and investors grabbing that yield is into municipal bonds. So there's this component of tax equivalent yield where you can get even higher than this 5% you're getting from a money market. So we are seeing more investors make those moves, and actually launched our 82nd ETF this year after having not launched a product since 2021. Back in March, we launched a short-term municipal bond product. The ticker is VTES, VTES. Already up to 170 million in assets under management, and just gives those investors looking for a muni exposure an opportunity to also go to the shorter end of the curve with the duration around 2.5 years.
And I think the fact that Vanguard only has 82 ETFs, it surprises me every time I think about it, because then you think about your asset base and it's pretty huge. And then you think about BlackRock has over 300 ETFs. So when you look at the lineup right now, 82 ETFs, where do you still see white space for Vanguard to go?
Yeah, I mean, as we're talking more and more about fixed income, and we're seeing new products enter the space, we're seeing new issuers enter the space, we're seeing new product types being active enter the space. I think there are a lot of opportunities for the broader ETF industry and community to think about what are we able to provide in this structure now that maybe we hadn't been in the past? What does the ETF rule kind of helped us work through in launching products quicker? I think there's a lot of opportunities, and a lot of issuers are thinking about active taxable fixed income in ETFs.
You're going right where I wanted to go, because Eric Balchunas, who of course is in Hollywood, Florida right now, wrote a column on how the time might be right for Vanguard to begin launching active ETFs as a way to absorb some of the outflows from its active strategies the last 5 years. What's the case for doing that versus not doing that?
I mean, I think for us and for any other issuer looking to launch active products, there's this component of transparency around your holdings. And if portfolio managers are really focused on adding alpha, I think they're being thoughtful about what they want to be able to disclose on a daily basis, and how much of that juice they really want others to know as far as what positioning they have on in their portfolios. So it remains to be seen if there's really going to pick up this traction in active taxable fixed income, but it does seem there's a lot of opportunities and there's a lot of investor demand in this space.
Well, to that point, I mean, we've seen, 30% of all ETF flows this year go into active vehicles, even though if you look at the actual assets in the ETF industry, they only command about 5% of that share. Going to be interesting to see if that changes. But I'm wondering, Janel, do you worry at all that Vanguard might be a little bit late to the active game, because you've seen Dimensional, JP Morgan, just to name a few, really go after that active space. Morgan Stanley, too, has big ambitions. And even still, I know Vanguard does have active ETFs out there. It seems like the reputation of Vanguard is these extremely passive, low-cost products.
Yeah, I mean, if you look at our mutual fund lineup, we've been dedicated to really building up expertise in fixed income, and we've got a really great team over in our fixed income group that has a lot of tools in their toolkit. It's really just how do we think about what our clients need? Like you said, where is that white space, and how does that line up with what we're able to offer at the lowest cost in the ETF vehicle? Something else while we're talking about asset allocation a little bit is just, we've talked a lot about fixed income, active fixed income, et cetera, but I think it's important also to think about an investor's strategic asset allocation. And while we've been talking about fixed income so much, equity markets have really been on a tear. So broad markets are up over 9%. Tech stocks, mega growth stocks, up over 25%. So it's important to just keep your eye on the prize and think about your long-term asset allocation in total.
Janel, great to catch up with you. Really appreciate your time, as always. Our big thanks, of course, to Janel Jackson of Vanguard. And coming up, we're going to go live to the Inside ETFs conference to discuss the innovation, the growth in the ETF industry. That's next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with triple leverage treasuries. We're looking at TMF. This is the direction daily 20-year treasury bull 3 times ETF. So if the bond market wasn't volatile enough for you, here you go. And this is really interesting because you're looking at total assets here, and you can see they've absolutely hockey sticked over the past year or so at an all-time high of $1.7 billion right now, even though performance of this fund hasn't been too great. People clearly jumping on that trend. Let's also talk about gold. GLD, this of course is the biggest gold ETF, and you're looking at weekly inflows here with just notched its 4th straight week of inflows. It also had that nice stretch a few weeks ago. And this is interesting because, as you can see, for a while it was bleeding money, but now investors clearly going for gold, if you will. But Scarlet, let's talk about AI, because as we teased in the opening, this is the buzzword of the year. And right now you're looking at bots. So this is a Global X product that is the Global X Robotics and Artificial Intelligence ETF. You're looking at it compared to the S&P 500. You have bots in white. It has absolutely powered past the S&P 500 in terms of returns. A lot of those gains coming from NVIDIA. Let's talk about this issue, AI and others, with our own Eric Balchunas, who of course is joining us live now from the Inside ETFs conference in Hollywood, Florida. Eric, what's the vibe like? What are the conversations centered around at this event?
Yeah, I mean, I think it's a lot of marketing and innovation, as it's always been. But this conference has evolved over the years. It's become a little more mainstream, a little more corporate. I think when you think about some of the predictions we've seen lately from JP Morgan and BBH, the people making the big predictions now are really the epicenter of Wall Street. And so that's being reflected here. So pretty much everybody's bullish. I mean, there really isn't a ton of education anymore. It's a little bit more about how to use ETFs in a portfolio, innovation, taxes. Remember, this conference also has now merged with an advisor conference called WealthStack, which makes sense because advisors are the biggest users of ETFs by far. They make about 70% of the user base of ETFs. So those two worlds collided here makes sense to me. So a lot of the content also is on advisors' world and how do they grow, how do they deal with certain issues and technology and whatnot.
That makes total sense. And of course, Eric, you've been a regular at this Inside ETFs conference for years now. And I remember you used to tell me how in years past there was a lot of focus on ESG when there was demand for allocating money to sustainable investments. But then, of course, in the last few years, ESG became a political battleground. Tell us a little bit more about what are the themes, what are the conversations when it comes to ETFs this time around? ESG,
I moderated a panel on ESG yesterday, and look, a bucket of cold water has been thrown on this space, and it probably needed it, okay? It got a little crazy with the marketing. It had a good back test, but then value and energy did well, and some ESG ETFs have underperformed. So a lot of the conversation yesterday was like, these big, broad ESG ETFs are supposed to go into core of your portfolio. Be a little more skeptical of them, because what are you owning? MSCI is different than S&P. And so I think where we're going to see a lot of movement in the positive for ESG is more towards the thematic and concentrated side. So for example, something you can add on top of, you just had Vanguard on top of your cheap Vanguard fund in the core. A good example was Crane Shares was on the panel. They have one called the Carbon Credits ETF KRBN. That's a really unusual ETF. It doesn't have anything to do with, say, a beta fund in the US. And what's interesting about that is a lot of ESG issuers are buying carbon credits in order to satisfy their ESG checklist. So in a way, you're getting a lot of ESG money in the carbon credit space. So I think we're going to see a lot of innovation in order to try to deal with the fact that ESG is got a big reality check, especially the ones that want to be in your core. I think those are going to have a limited ceiling, but the thematic side, I think, has a lot of room to grow.
Right, a big asterisk next to the term ESG. And let me just jump in here. We have some headlines. Kevin McCarthy, the Speaker of the House, saying that we don't have a deal. He is speaking to reporters in regards to debt ceiling negotiations. He says on the Biden meeting, decisions have to start being made. Now, it's not clear whether this is in advance of the Biden meeting, because they're scheduled to meet at 5:30 p.m. today, Eastern time. But Kevin McCarthy, for the moment, saying there is no deal on the debt ceiling standoff. And as a result, we're seeing equities come down a little bit, and the 2-year yield also ease off a little bit to just above 4.3%.
And of course, we're going to be following that story all day, all week, all month, probably, as we count down to that X date. But Eric, bringing it back to Florida, let's talk a little bit more about the conversations, because I remember when you and I were in Miami at the Exchange Conference back in February, the hot topics were dividends, they were income, they were sort of the boring sort of boilerplate asset allocation decisions. What is the main topic right now, and what are people saying about artificial intelligence, for example?
That's a great example. So it used to be like, oh, let's debate smart beta, let's debate ESG. I think AI is going to be one of the next big debate points. We're just at the beginning of that cycle. Look, AI is really just an evolution on smart beta, right? You're taking artificial intelligence and trying to basically beat the market with a bunch of computing power. Now, I will say a couple things here. A lot of the turnover and the trading, some of these ETFs have a lot of trading, and those costs are hard to get over. So AI is going to have the same problem as a traditional active manager in trying to keep costs down, making the right picks. So there's nothing really new about trying to beat the market. It's just using computers to do it. So I think we'll see some action there, but I don't think it'll be like something that takes over. And on the flip side, it's about AI thematic ETFs. You know, the chat ETF just came out, but there aren't that many pure play AI companies to invest in yet. So that has a lot of big FANG stocks. So I think we're going to have to see that world develop a lot more. But I was at the SEC on Friday at one of their conferences, and Gensler said AI would be bigger than the internet. And they're looking at, how to regulate it in the financial space. So it's going to be big. I don't know how big in the ETF world, but certainly there's a lot of excitement here about AI.
Eric Balchunas, great stuff. As always, of course, joining us from Hollywood, Florida. Make sure you wear your sunscreen. Still ahead, though, on this show, we're going to stick with artificial intelligence. Talk about it with Art Amador. He is the co-founder and COO of EquBot. That's next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Scarlet along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. The ETF in question today is AIEQ. This is the AI Powered Equity ETF. Basically, the way this works, it uses a quantitative model that runs 24/7 on IBM's Watson platform. It assesses more than 6,000 U.S. public companies each day and basically scrapes regulatory filings, news stories, management profiles, etc., to come up with a basket of stocks. To do that, it charges 75 basis points. So let's take a little bit of a look at that basket. And it's interesting. It's mostly internet and software companies. You can see right up at the top there, it has Palantir as its top holdings. You go down the list, you see Cloudflare, you see Datadog, Upstart, etc. You can also see Alphabet represented in that portfolio as well. So again, a very tech-heavy sort of ETF. I thought it makes sense to compare its returns to the NASDAQ 100. And if we take a look at performance over the past 5 years ago, it looks like the market is winning there. You can see that the NASDAQ 100 is up more than 100% over that time on a total return basis. You compare that to how AIEQ is doing, only up about 17, 18% over that time frame. So still a gain, Scarlet, but not as good as maybe the NASDAQ 100 alone.
Yeah, Watson needs to buy some Apple and NVIDIA, apparently. All right, Katie, thank you so much for that roundup and that framing, because joining us now to talk about this ETF is Art Amador. He is co-founder and COO of EquBot, an AI-driven portfolio management and market intelligence platform. Great to speak with you, Art. It was notable when Katie was going over some of the top holdings that Palantir and Alphabet are there. It feels very meta that you have an AI tech investing in AI-type companies. Talk a little bit about the inputs that Watson is using to determine the best picks.
Yeah, so AIQ takes a comprehensive approach. So we leverage a lot of unstructured data. So we're analyzing millions of news articles, social media posts every single day, and we extract the sentiment and also the intent. Intent meaning, what does it mean? We then combine that information with macro data, fundamentals, and technical data to make a prediction on about 5,000 U.S. publicly traded companies to understand which ones are going to have the best price appreciation. And then we select about 150 names that have the best opportunity for that price appreciation. And right now, you're right. It's leveraging. It looks like it's writing the AI and cloud theme at the moment. However, it does change over time. Katie wrote a great article back in January, and it was really heavy consumer discretionary.
Yeah, so talk to us a little bit about that turnover, because when I was writing that article, it stuck out to me how much turnover this ETF has. And Eric Balchunas, he's not here, but he's looming large over this show. He made the point that if you look at AIEQ's turnover rate, it's something close to 1,700% over one calendar year. Where do those transaction costs show up? Is that something that you have to eat on your end, or is that something that the end client has to ultimately pay for?
Yes, I think there's two elements when you're concerned about turnover, right? One is the transaction costs, and the other is the taxes. And so the ETF vehicle, when we thought about how are we going to leverage an AI strategy, what would be the best vehicle for that? We ultimately went with an ETF because as it relates to taxes, AIEQ did pay taxes initially the first year, but since then we've been able to avoid any capital gains distributions. Now the turnover is completely data driven. So in earlier years, it might have been as low as 200 or 300%. You're right, last year was higher. 2022 was a market anomaly. And so the system was trying to identify trends during that time. And there was a lot that was going on last year, and not in a good way. So there was more turnover than has historically been. But the transaction costs, yes, there's a bid-ask spread when you're trading stocks, and also a price that you pay per share. Obviously, it's an ETF, so it's institutional pricing. But transaction costs are built into the models. So when it makes a decision on whether or not to sell a stock and buy another, it takes into consideration the transaction costs as well.
All right, Art, really appreciate your giving us the breakdown there on AIEQ. Art Amador of ETF Managers Group joining us on the fund. We do have some more breaking news here from Kevin McCarthy, the Speaker of the House. He does say that negotiators, their meeting this morning was productive and that they will continue working, but they're not at a deal at the moment. Remember, McCarthy had given comments a little bit earlier on, Katie, saying that we don't have a deal at the moment, and decisions will have to start being made when it comes to his meeting with President Biden at 5:30 p.m. this evening.
And of course, I mean, we're seeing this anxiety in the market. The epicenter, of course, has been the Treasury bill market. It was interesting, actually, earlier today, the U.S. sold 3-month Treasury bills at a yield of 5.25%. That was the highest since 2001. So clearly that anxiety is there when you look specifically at the bill market. But for now, for us, that does it for Bloomberg ETF IQ. I'm Katie Greifeld, along with Scarlet. Thank you for joining me.
It's always a pleasure.
Yeah, all right. This is Bloomberg.